Hey everyone, and welcome to the AI Tech channel. Today, we're diving deep into a question that's been swirling around the tech and investment worlds. Is Elon Musk's divided attention a ticking time bomb for Tesla, or is this just noise obscuring a massive opportunity? Daniel Ives from Wedbush is saying buy, but is he seeing something the rest of us are missing? Stick around, because we're about to break it all down. We're not just going to tell you what's happening, we're going to show you how to navigate this complex landscape. Get ready, because this could change how you see Tesla forever. Are you ready to explore? Let's get straight to the heart of the matter. Tesla's stock has been a roller coaster, and everyone's asking, what's next? Daniel Ives, a top analyst at Wedbush, just reiterated his outperform rating on Tesla with a street-high price target of $550. That's a potential 55% upside from current levels. Now, that's a bold claim. But here's the kicker. Ives acknowledges the elephant in the room. Elon Musk's other ventures, like X, SpaceX, and XAI. The big question is, can Musk really juggle it all without dropping the ball on Tesla? He sees a lot of the negative sentiment as noise. Let's find out. Ives admits that Musk's involvement with Doge and his association with certain political figures could alienate some Tesla customers. He even acknowledges some momentum around this effort in Europe and pockets of the US. Ouch, that's not something you usually hear analysts openly admit. The fear is that consumers might hesitate to buy a car tied to Musk's personal brand, especially with increasing competition in the EV market. But Ives isn't panicking. He views these as containable brand issues that won't have a major impact on Tesla's long-term potential. But is he right? Are these brand issues truly containable, or are they a slow-burning fuse? Another major concern is that Musk's focus on Doge and other projects is distracting him from Tesla at a critical time. Think about it. Tesla is facing intense competition in autonomous driving and robotics, both in the US and China. A distracted CEO is the last thing investors want to see. Ives calls out the bears who are focusing on this Doge issue and brand worries. He argues that this narrative doesn't change the fundamental future of Tesla. But can Tesla really afford to have its leaders spread so thin? It's a valid concern, and one we need to unpack further. It's the concentration of effort that we need to focus on. Here's where Ives gets really bullish. He points to multiple projects that are about to come to fruition. Tesla is preparing for a new mass-market vehicle launch in the first half of 2025. They're making major product developments in autonomy and Optimus, and they're planning the Austin unsupervised FSD launch for June. Plus, there's a host of other growth EV/battery catalysts on the horizon. This is a huge pipeline of potential growth drivers. But can Tesla deliver on all these promises? That's the million-dollar question. These projects are not just incremental improvements. They are revolutionary. Ives believes the upcoming Model Y Juniper launch and the Austin FSD unsupervised kickoff in June will be key events and catalysts. He thinks investors will start focusing on Tesla's next chapter of growth. And he believes Musk will successfully balance his Tesla CEO role with his other ventures. That's a critical assumption. It's the linchpin of his bullish thesis. But what if Musk can't pull it off? What if the distractions become too much? What if the competition becomes too fierce? These ifs are what keep investors up at night. They're the reason why Tesla's stock remains so volatile and why expert analysts are divided. Now, here's where it gets interesting. While Ives is super bullish with his $550 price target, the street consensus is much more skeptical. Out of the analysts covering Tesla, 12 agree with Ives and rate it a buy, but 12 others have a hold rating, and 10 are saying sell. The average price target is $351.38, suggesting the stock will stay range-bound for the foreseeable future. That's a huge difference of opinion. It highlights the uncertainty surrounding Tesla's future. It shows that even the experts can't agree on what's coming next. So, who should you believe? That's what we're going to help you figure out. Let's talk about the elephant in the room, AI. Musk's XAI is deeply intertwined with Tesla's future. Full self-driving, Optimus, and even battery technology are all heavily reliant on advancements in artificial intelligence. Tesla isn't just a car company anymore. It's an AI company on wheels. This is where the potential for exponential growth lies. But it's also where the risk is concentrated. If Tesla falls behind in the AI race, it could lose its competitive edge. Musk's vision of an AI-powered future is either a stroke of genius or a recipe for disaster. It all hinges on execution. Let's look at the technical challenges. From a technical standpoint, achieving level 5 autonomy, that's full self-driving without any human intervention, requires solving incredibly complex problems in computer vision, sensor fusion, and decision-making. We're talking about algorithms that can handle unpredictable events, navigate complex traffic scenarios, and adapt to changing weather conditions. This isn't just about writing code. It's about creating AI that can reason and react like a human driver. Tesla's approach relies heavily on neural networks and vast amounts of training data. But even with all that, challenges remain. These things will make or break the future of Tesla. Here are three to consider. 1. The limitations of current sensor technology. 2. The difficulty of generalizing from training data to real-world scenarios. 3. The ethical dilemmas surrounding autonomous driving. Tesla isn't the only player in the AI-powered EV game. Companies like Waymo, Cruise, and even traditional automakers like Mercedes-Benz are making significant strides in autonomous driving. And let's not forget about the Chinese EV makers, who are rapidly catching up in terms of technology and market share. The competition is fierce, and Tesla needs to stay ahead of the curve to maintain its dominance. This is where Musk's leadership and focus become critical. He needs to rally the troops, inspire innovation, and drive execution. Can he do it while juggling his other ventures? That's the big question mark hanging over Tesla's future. It's a race against time, and the stakes are incredibly high. Ives argues that the brand issues and Musk's distractions are containable. But what does that really mean? How can we measure the impact of these factors on Tesla's bottom line? This is where things get tricky. It's difficult to quantify the intangible effects of brand perception and CEO focus. We can look at sales figures, customer surveys, and social media sentiment. But these are just proxies for the underlying reality. The truth is, we can't know for sure how much these factors are affecting Tesla's performance. But we can make educated guesses based on the available data. And that's what we're going to do. But how can one actually measure the impact of a brand perception? Well, you can try using brand equity measurement models. There are several well-established brand equity measurement models that can help us assess the impact of brand perception on a company's financial performance. One popular model is the Brand Asset Valuator, BAV, which measures brand strength along 4 dimensions: differentiation, relevance, esteem, and knowledge. Another model is the Interbrand methodology, which calculates brand value based on financial performance, brand role, and brand strength. By applying these models to Tesla, we can get a better understanding of how Musk's actions are affecting the company's brand equity. This is not just about feeling, it's about data. If Tesla's brand equity is declining, it could lead to lower sales, reduced pricing power, and increased customer churn. This is a risk that investors need to be aware of. Now, let's think about a paper by Ocker on building strong brands. David Ocker's work on building strong brands emphasizes the importance of brand identity, brand positioning, and brand personality. According to Ocker, a strong brand should have a clear and compelling identity that resonates with its target audience. It should also have a unique positioning that differentiates it from competitors. And it should have a personality that reflects its values and beliefs. In Tesla's case, the brand identity is closely tied to Elon Musk's persona. He is the face of the company, and his actions directly impact the brand's image. If Musk's actions are perceived as controversial or distracting, it could damage Tesla's brand identity and erode customer loyalty. This is a risk that Tesla needs to manage carefully. So what's the solution? How can Tesla mitigate the risks associated with Musk's distractions and brand issues? Here are a few ideas. First, Tesla could try to diversify its leadership team and reduce its reliance on Musk's persona. This could involve promoting other executives to more prominent roles and giving them more visibility. Second, Tesla could invest in brand-building initiatives that emphasize the company's technology and innovation rather than just Musk's personality. This could involve launching new marketing campaigns, sponsoring scientific research, and partnering with other tech companies. Third, Tesla could improve its communication strategy and be more transparent about its challenges and opportunities. This could involve holding regular investor calls, publishing detailed financial reports, and engaging with customers on social media. These steps will go a long way. So what should you do with Tesla stock? Here's my take. If you're a long-term investor who believes in Tesla's vision and its potential to disrupt the automotive industry, then you might want to hold on to your shares. But be prepared for volatility and don't put all your eggs in one basket. If you're a more risk-averse investor, then you might want to consider reducing your position or even selling your shares altogether. There are plenty of other investment opportunities out there, and you don't need to take on unnecessary risk. And if you're thinking about buying Tesla stock, then do your homework and weigh the risks and rewards carefully. Don't just listen to what the analysts are saying. Form your own opinion based on the available data. It's all about balancing risk and reward. The future of Tesla is uncertain. There are plenty of challenges and opportunities ahead. But one thing is clear. Tesla is a company that's worth watching. It's a company that's pushing the boundaries of technology and innovation. And it's a company that's changing the world in profound ways. Whether you're an investor, a tech enthusiast, or just a curious observer, Tesla is a company that deserves your attention. Who knows what the future holds? But one thing is for sure, it's going to be an exciting ride. So, buckle up and get ready for the next chapter in the Tesla story. And don't forget to hit that like button and subscribe to our channel for more in-depth analysis of the tech world. What do you think? Is Musk a genius or a liability? Let us know in the comments below. Thanks for watching.